Welcome to our exploration of the MLC Superfund scandal uncovered by the Australian Banking Royal Commission. We'll examine the unethical practices that impacted over 200,000 Australians, the ethical breaches involved, and how adhering to CFA ethical standards could have prevented it. Let's begin.
Hello, my name is Anadi, and in this video, we talk about the intervention of the Royal Commission in MLC Superfund case. In 2017, the Australian government launched the Royal Commission into Misconduct in banking, superannuation, and financial services industry. This was in response to the alarming reports of unethical behavior by some of the Australia's most trusted financial institutions. Among those exposed for serious misconduct was MLC Superfund, owned by NAB, one of Australia's largest banks. MLC Super was found guilty of unethical practices, most notably charging customers fee for services they never received over nearly a decade. These actions left over 220,000 Australians financially disadvantaged and significantly damaged public trust in the nation's financial services. In this video, we explore how these issues came to light, the unethical breaches involved, and far-reach social and financial impacts of these actions.
Hi, my name is Gaurav, and today I'm going to talk about the MLC's case, Superfund case. The Royal Commission into Misconduct in Banking, Superannuation and Financial Services Industry was initiated in 2017. It was established to investigate unethical and illegal practices within Australia's financial institutions. Among those exposed was MLC Superfund, owned by NAB, one of the nation's first and largest banks. MLC Super was found to have engaged in unethical practices such as charging fees for no service and misleading customers. Between 2009 and 2018, MLC charged customers $100 million for services they had never received. The Royal Commission revealed that MLC and its parent company NAB had systematically charged over 220,000 customers with providing any financial advice. This fraudulent activity continued nearly for over a decade, leading severe consequences. Following the Royal Commission's findings, MLC Super was ordered to refund over $117 million to the affected customers. On top of that, MLC's parent company NAB faced fines and penalties exceeding $57 million for their role in misconduct. These penalties were a direct response to their failure to act in the best interest of their clients. The consequences didn't end there. Senior executives at NAB, including the CEO and chairman, were forced to resign due to the public outcry and loss of trust. The Royal Commission also required extensive reforms within the organization to ensure that unethical behavior could not be repeated. For thousands of Australians affected, the damage was already done. Their retirement savings were diminished, and many of them were left uncertain about their financial futures. The Royal Commission's findings brought a widespread of reforms across the financial sector, increasing oversight and strengthening customer protections. While MLC and NAB faced significant penalties, the Commission's work not only held them accountable but also set a new standard for the financial industry. Australians can now look forward to the future where superannuation funds are more transparent, fair, and ethical in their practices. In this video, we'll dive into detail about how things took an unethical turn at NAB and MLC Fund.
Hi, I'm Nai. Today I will discussing about the ethical issues surrounding NAB's MLC Superfund. First, one of the major ethical breaches was charging fees for services that were never provided. This not only violated the trust of fund members but also exploited them financially. Superannuation is meant to provide long-term security, and by imposing fees for services members didn't receive, NAB undermined that purpose and harm their financial futures. The second one, there was a clear lack of transparency with members. Trust between a financial institution and its members is critical. However, MLC failed to clearly disclose how fees were being charged and how members' money was being managed. This breach of transparency directly impacted members' ability to give informed consent regarding their own funds, violating their right. Third one, new list and the trustee of the MLC super fund had a fiduciary duty to act in the best interest of its member. Unfortunately, new list failed to prevent unethical practices like fee for no service scandal. This further highlights a breach of fiduciary responsibility where the pursuit of financial gain was prioritized over protecting members. Now, let's consider the ethical theories that apply to this situation. From a deontological perspective, NAPS and new list had a duty to act ethically and ensure that members' rights were upheld. They clearly violated this duty by not delivering the services members paid for money and by failing to be transparent about fees. Their duty to protect members' rights was neglected. From a utilitarian perspective, the harm caused to thousands of members far outweighed any potential benefit to NAPS. Superannuation is designed to ensure people's financial security in retirement, and by exploiting members, NAP significantly diminish their overall well-being and happiness. So in conclusion, these unethical practices like charging fees for no service, lack of transparency, and failure to uphold fiduciary duties not only damage the trust of fund members, but also cause long-term financial harm that undermine the very purpose of the superannuation.
Oh, hi, I'm Olivia. Now I'm talking about one of the most significant financial misconduct case in recent Australian history, the fallout involving MLC nominees. So MLC nominees, like a subsidiary of NAB, face legal action brought by Australian Security and Investment Commission, or ASIC. The case was centered around the unlawful charging of land service fees and advisor service fees without providing the corresponding financial services. The federal court proceeding focused on holding MLC nominees accountable for these practices. ASIC filed penalties against the company, aiming to address the unjust fee charged to over 220,000 members of superannuation on funds under company trusteeship. Compensation to the affected member has been significant. MLC nominees were ordered to pay more than $34 million in compensations, including interest payment to those who were wrongfully charged free over several years. The remediation process has also led to large-scale overhaul of internal systems to prevent this from happening again. But the financial penalties were just one aspect of this case. The reputational damage was perhaps even more profound. The Royal Commission's findings, which uncovered widespread misconduct in the financial services sector, severely tarnished the image of both MLC nominees and its parent company, NAB. Public trust in their wealth management services took a hit, sparking a median backlash to continue to have a long-lasting effect. As a direct result of this scandal, NAB eventually restructured its wealth management divisions and sold off its MLC wealth business in 2021. This move was seen as an effort to distance the bank from the issues uncovered by the Royal Commission and to restore its standing in financial market.
My name is Kim. I will discuss how greater adherence to the CFA ethical standard could have prevented misconduct at MLC nominees and MLC Limited. Let's break down the key standards and their impact. First, Standard 1A, knowledge of the law. This standard requires strict compliance with all law and regulation. MLC violated this by charging fee for services that were never provided, clearly breaching Australian law. If they had adhered to this standard, these illegal fees would have been avoided, protecting their client and insurance transparency. Next is Standard 3P, Fair Dealing. This standard ensures fair treatment for clients. MLC charge fees for no service, which is a clear violation of fairness. By following this standard, MLC would have been transparent, charging members only for services they actually receive, ensuring fair and ethical practice. Lastly, Standard 3E, Preservation of Confidentiality. While this focus on protecting client information, it also emphasizes safeguarding clients' financial interests. MLC prioritizing profits over its clients by charging unjustified fees. Upholding this standard would have meant acting in their client's best financial interests, preventing the scandal altogether. In conclusion, if NLC had followed these CFA standards, knowledge of law, fair dealing, and preservation of confidentiality, this entire issue could have been avoided. It's clear that ethical conduct matters in protecting both clients and the integrity of the financial industry. That's how strong ethics could have made in a big difference. Thank you.
The social impact of MLC Super's misconduct were far-reaching, affecting both individuals and broader trust of Australia's financial systems. For thousands of Australians, the immediate consequence was a reduction in their retirement saving, creating long-term financial insecurities for people who had relied on the funds for their future. This breach of trust left many questioning the integrity of financial institutions in general, weakening confidence in the superannuation system, a cornerstone of Australia's retirement planning. Additionally, the scandal underscored the power imbalance between large financial corporations and everyday citizens, highlighting the need for stronger regulatory oversight to protect vulnerable consumers. The damage wasn't just financial. Public faith in the ethics and governance of financial institutions was profoundly shaky, necessitating wide-range reforms to restore transparency and fairness across the sector.
So, in conclusion, the misconduct by MLC Superfund illustrates the profound consequence of unethical practices in the financial sector. The Royal Commission finding led to significant penalties, compensation for affected members, and lasting damage to MLC and NAB reputations. This case highlights the importance of transparency, accountability, and adhering to ethical standards to protect customers and restore trust. Moving forward, it's essential for financial institutions for priority their client best interest and ensure that such breaches of trust do not happen again, fostering a more ethical and reliability financial system for the future. And we are Group 3. Thanks for watching our video.